Good morning. It is Wednesday, January 7th, 2026. Welcome to the most schizophrenic market on planet Earth. If you read the headlines this morning, the sky is falling. The trade war isn't coming. It's here. General Motors is taking a $5 billion hit. Stanley Black Decker is slashing guidance. China is accusing the U.S. of bullying, and the supply chain is officially choking. But if you look at the bankers on Wall Street, they're throwing a party. The IPO floodgates just burst open. Klarna, Gemini, BlackRock Coffee, they're all rushing a list right now. So here's the conflict for today. The macro freeze versus the capital rush. Main Street businesses are getting crushed by the cost of goods, but Wall Street is betting that the consumer is strong enough to pay the bill. Who blinks first? The company paying the tariff, or you, the customer? Let's diagnose the damage. And this is the pre-market pulse. Deep Dive 1. The Profit Squeeze. Let's start with the lead story, because the bill for protectionism just arrived, and it is ugly. For months, tariffs were a political talking point. Today, they are a line item on the P&L. We have a cluster of major industrial giants capitulating this morning. First, look at General Motors, $GM. They just cut their 2025 profit forecast. Why? A projected $5 billion impact from tariffs. They're trying to mitigate it by moving supply chains, but you can't move a factory overnight. They're banking on offsetting 30% of that cost, but that still leaves a massive hole in their margins. Next, Stanley Black Decker, SWK. This is the canary in the coal mine for the housing and construction market. They cut their 2025 profit forecast significantly. CEO Donald Allen Jr. explicitly said they are hiking prices to deal with it. Translation: that power drill you want to buy? It just got 10% more expensive. And it's not just the Americans. Honda, HMC, sees a 59% drop in full-year profit as U.S. tariffs bite. McCormick, MKC, the hot sauce and spice people, are forecasting tepid sales because costs are rising. The takeaway: we are entering a profit recession for goods-producing companies. If you're holding the Industrial Select Sector SPDR, XLI, or Consumer Discretionary XLY, you are in the blast zone. These companies have two choices: eat the cost and crash margins, or pass it to you and crash demand. Based on today's news, they are choosing a bit of both. Deep Dive 2. The Geopolitical Chessboard. Now, zoom out to the macro story. While companies bleed, nations are maneuvering. The trade war isn't just about taxes, it's about alignment. And today, we see two very different strategies playing out between the two Asian giants, India and China. Strategy A. Appeasement. India. India is playing the game perfectly. We have reports this morning that Indian refiners, specifically Indian Oil Corp, IOC, are boosting purchases of U.S. crude oil. Why? To narrow their trade deficit with Washington. They know the Trump administration is targeting trade surpluses, so India is voluntarily buying American energy to keep the target off their back. They are even considering scrapping import taxes on U.S. LNG. The trade. This is bullish for U.S. energy exporters. Watch the pipelines and the LNG exporters like Cheniere, LNG. India is paying the protection money. Strategy B. Retaliation. China. China, on the other hand, is digging in. The Tik-tok deal is officially on ice. Sources say Beijing signaled it would reject the spin-off of TikTok's U.S. assets specifically because of the new tariff announcements. China's Commerce Ministry is calling the U.S. actions unilateral bullying. They are also launching an anti-monopoly investigation into NVIDIA. Why this matters to your wallet? The decoupling is getting messy. If the TikTok deal dies, that's billions of dollars in M&A fees and value vaporized. If NVIDIA gets locked out of China or fined, the AI trade takes a direct hit. We are moving from a trade war to a tech cold war. Also, keep an eye on Shine. Their London IPO is falling apart because Trump's tariffs destroy their business model of shipping cheap clothes directly to doorsteps. The era of cheap, tariff-free consumption is over. The silent mover, lithium and the green crash. While everyone watches oil and chips, something critical is breaking in the background. Lithium. Look at the Australian miners this morning. Pilbara Minerals and Mineral Resources are getting slaughtered. Citi just cut their price targets across the board. Here is the irony. The U.S. wants to dominate the EV market and compete with China. But the new tariffs are making it impossible to get the raw materials needed to build the batteries. The reciprocal tariffs are acting as a headwind for demand. If you're holding the Global X Lithium and Battery Tech ETF $LIT, you are catching a falling knife. The market is pricing in a scenario where the green transition gets put on pause because the supply chains are too expensive to function. The signal: this is deflationary for the EV sector. Tesla, $TSLA, and Rivian, $RIVN, need cheap lithium. If the miners stop digging because the economics don't work, the battery shortage of 2027 starts today. The lightning round. Let's translate this mess into 3 specific trades. Rapid fire. SWK, Stanley Black and Decker. Verdict: bearish. Why? They just cut 2025 guidance, and admitted tariffs are crushing margins. In a high-rate, high-tariff environment, you do not want to own the company selling tools to a slowing housing market. Sell. Ericsson. Verdict: bullish. Why? Surprise winner. Their North American sales are up 20% as carriers buy gear ahead of tariffs. They are beating Nokia, they are growing in the U.S., and they are managing the trade war better than anyone else. Buy the dip. CDS, Cintas. Verdict: bullish. Why? Aggression. While others are cowering, Cintas is trying to buy its rival UniFirst, UNF, for $5.3 billion. They're using M&A to consolidate the market and cut costs. In a recessionary environment, the consolidator wins. Here is your playbook for the next 24 hours. Watch the IPOs. Keep an eye on Klarna and Gemini pricing. If these deals price well despite the tariff news, it means there is still massive liquidity in the system waiting to buy growth. Fade the industrials. Avoid XLI and automotive stocks, GM, HMC, until the tariff dust settles. The guidance cuts are just beginning. Monitor Dr. Copper. Keep an eye on Freeport-McMoRan, FCX. They beat earnings slightly, but if copper breaks lower, the global economy is signaling a hard landing. The trade war is loud, but the charts are louder. Listen to the price action. This is the pre-market pulse. We scrape the noise, you trade the signal. If you like our content, remember to hit that subscribe button.